Good afternoon, good morning, good evening. Today is the 19th of October, 2017, and today I'm going to do a little bit more talking, but I'm also going to do some analyzing of a couple of the dollar pairs that I've spoke about since Monday, and also bring in the Aussie dollar. But what I want to talk about basically is more about your particular style of trading and the way you manage your risk. Now, what I've noticed with Elliott is, and any other technical analysis that you actually use in your trading style, nothing is 100% accurate. They all are pretty much just guidelines, and through that, it gives you more of an advantage in particular markets. But at the end of the day, you never know exactly what the market is going to do until it does it. And then basically based on that, you can take a trade and you just make sure that your risk is very low and the possible reward is going to be a lot higher than the risk. That's pretty much the name of the game. How much are you willing to risk? So when it comes to stop losses and any of that, my strategy is whether the market is going up or down. When I take a trade, I'm basing it pretty much off of Elliott for the most part. I do also do a little bit of common sense, and then I have the other technicals to pretty much assist me in making my decision. From that, whether the market is going in an uptrend or downtrend, I have to keep that in mind. But one thing that I look at is if I take a position or a trade, a scalp or whatever, in the opposite direction of the particular trend, I need to at least ask myself, is this particular trade worth the risk? So if let's just say for the dollar, basically the euro dollar. So if we look at the dollar, let's just start. I actually don't even want to. I want to go to the Aussie. So I want to start off with the weekly. Now, clearly on the weekly, Aussie weekly since 2012, price has been trending down. I mean, it's clear, and you can easily clearly see from Elliott's terms a five-wave pattern down. And this is just basically not even all of the particular information. I can bring in probably, let's see, 600. Let's see if I brought in more data. But basically, you have a 1, 2, and then a 1 of 3, 2 of 3, and then through that particular, in wave 3, you have a 1, 2, possibly 3, 4, 5 for 3, and then a wave 4, and then wave 5. Now, on my alternate, I always have a primary and alternate because at the end of the day, you don't know what's going to happen in the market. So I have this as wave 3. I have this as wave A. I have this as wave B. And then this could possibly be the end of wave C for wave 4, which basically ended near the levels of the previous wave 4 in the wave 3, basically. That should make sense to you if you know Elliott. With that being said, clearly if you go down to a daily or a smaller time frame, you can count 5 waves down in this particular impulsive wave here. So there is evidence that it is possible that this top at 81.20 or so could easily be the top. Everything in relationships to wave A, in relationships to the wave 4 of one lesser degree, it all adds up. So this could easily be, you could easily say that it has reached its level of wave 4. And not to mention, when it comes to the dollar's strength, it also aligns with the dollar exchange and a few other of the dollar pairs. So why am I looking to go long? Or in the past, I was looking to go long the Aussie dollar, not short. Well, let's go to a smaller time frame. Let's go to a dollar. Now this is basically the triangle here, and then I actually have it as my primary. I have the top as a expanded flat wave B with a 5-wave move down for wave C, expecting one wave higher to the levels of possibly 83, 82, 83, about a mid 82 or so. If that was the case, then if I was to take a long anywhere in this particular trade, it would have to be basically more towards the levels of 78.25. I've probably already missed the best opportunity. But on the flip side, price would need to, the thing about it is you can count clearly 5 waves down. So from this top, you can count 1, 2, 3, 4, 5 for where I have my current alternate as wave 1. So then if you see this is 1, 2, and a possible 3-wave move up. So this can be the AF2 or possibly a W that can end at 79, give or take somewhere in this mid 79. So if you have a W, you will expect an X, right? So if you expect the X that will, or a B that will retrace this previous leg by at least a minimum of 50%, let's just say that prices goes back to 7,800 or so. In my opinion, and the way my trading style is I will go long, because either I'm going long for wave C or Y that will go above this particular high. So you're talking a 300+ pip move with a risk really only going at about 100 ticks. So that's a 3-to-1 trade. You figure that if it goes below this particular move here, then possibly that particular wave 2 will be invalidated. It's because if this is wave 1, well then wave 2 cannot retrace wave 1 more than 100%. So if prices was to come 50% of this particular current move, well then you'll probably expect prices to come down to that 7820, 7800 level. Why not get in the trade and you're only risking roughly 100 ticks to make roughly 300 or 400 ticks? It's an easy 3-to-1 trade. That's my strategy. However, let's just say that prices, this is the top, and now you already see wave. This is wave 1 down, and now you're going to basically see wave 2, which would probably find some resistance here at, let's say, 79.50 or so. Well, at that point, you can get in either way. Now you can go, if prices broke out of this particular resistance level, but then let's say it found extreme resistance here at about 80, I would look to go short. Why? Because I would just place my stop loss right at 81. So it's 100 ticks stop loss. But if this is correct and is going to the downside, you're basically going to expect eventually price needs to go at least back to 77, and then it will continue down, and it would eventually have to go below wave B, because at that point you would basically say that this is the top, this is wave 1, you have wave 2, and then now wave 3 would come all the way down to like 73. But this will be the start of wave 5, which basically has the potential to go below. It has to go below the 3. So if you look back at it weekly, it would need to go below this wave 3. If this is the top of wave 4, you have the 1, possible 2, and then 3, 4, 5 would needs to go below 68. Now, when it comes to a long-term trade, obviously there's more reward to the downside than it is to the upside, but it also depends on how you're looking at it. If this is wave 5, and then now you have an A, B, and a possibly C, that can be a larger wave A, because now you're basically going to see an ABC, which has the potential to come all the way back closer to about 95 or so. So if you have a whole cycle, a 5-wave cycle from this top on a weekly basis to this bottom, let's just say that this completed a 5-wave cycle, this is not the 3-wave correction is not going to end right here or right here. That 3-wave correction is going to retrace almost more than half of that, at least 0.618 or so. So you're going to expect prices to go more towards the previous wave 2 of basically of an ABC. And I see this in different dollar markets, which is why when I make basically when I'm trading, I have to look at it in two different ways. Okay, look, if it's bearish, then here's my invalidation areas. So if I take a trade, my stop needs to be somewhere near here. And if I get stopped out, that doesn't mean that the trade is wrong. That means that I wasn't willing to risk where the stop should have been, or I'm just not comfortable in taking a trade with that particular large of a stop to basically risk that amount. In corrections, it's very difficult to know what it's going to do. And I'm saying that because it can be a bearish or a bullish correction. In an impulse wave, in an impulse move, it's clear. It's clear. You can see from the two, after this basically two, everything has been down. So at some point probably here, I would have stopped trying to go long if I look back in history and saw to my left that everything was trending down. In this particular case here, since the low was hit, you're looking at over $10 since the low move. So you can take a short, but technically the market is still trending up. So there's nothing really wrong with trying to go long in this particular market when since about a year and a half now, prices have been trending up. If the 3 is in place, well then yeah, over the past couple of years, 4 or 5 years, price has been to the downside, but it hasn't been much room to the downside. Everything has been going up. So me and my logic of thinking is I'm going to try to take a move, a long position or a long scalp or a long swing trade until prices gets to an area where now I no longer see this market in a long move. In the Aussie, you're basically, you would need prices to come closer back to 70, 72 just to even consider that this is even the top. But I'm not going to sit here and wait until this is the top before I make that decision. I'm going to see where I am willing to risk and where I'm not willing to risk, and then I go from there. Because at the end of the day, we're all speculators. No matter what particular style of trading you trade, everyone is a speculator. You do not know what is going to happen in this market. You may think you know. You may have this whole, no one has a crystal ball. No one has okay, my Elliott analysis is so on point and so accurate that I'm always right. If you really think that, then I wouldn't follow you. And my mentor always told me, when you look for trades, make sure that you're looking for trades where your reward is greater than your risk. And if you are not willing to risk that much, then you trade small. That way, if you do get stopped out, okay, it didn't really hurt you. Take your emotions out of all of it. It didn't hurt you. You traded small. You were testing the market to see what was going on and testing your labels basically. And then when that validation or invalidation point is either met, then you take a larger position if you so choose. So in these markets, yes, I've been trading and getting 100 ticks here, 200 ticks there, 300 and 400 ticks here and there. But let's go over to the euro, and let's see what happened over the course of the last 24 hours, 48 hours or so. Where am I at? Okay, so as you can see, I'm up 56 ticks. Now, when I posted the video 2 days ago, I was up 96 ticks the opposite way. So basically, I was trading this wave down here. I had anticipated prices going below 17.25. Price did not do that. Price went up, and then on this particular bar here, when I realized that most likely it found its support at 1768, far above the 1728 or 1730 low is when I started looking for longs. Now, even though price went to 1768, I didn't get in this market until 1789. So you're talking, it took me 30 pips to say, okay, now I am comfortable going long in this position. And honestly, I'm still, even though I'm up 57, I am still not convinced that this current 1671 is the low. Why am I not convinced? Because you can clearly see from my count, I have this as a B, this is triangle B, and then I have this as an A and B. But this is a little bit forced. What if this was C, right? And if this was C, well then you have a 1, 2 basically. But in order for this to be validated, the 1, 2 count, price needs to go above 18, the previous top basically of 1880, just to even consider that it is possible that this is the low and this is wave 4. If not, then you have you still have my current primary A, B, and then you have a 1, 2. And with that 1, 2, price currently is roughly about 0.786 of the previous wave and on the Fibonacci level. So let's look at it so I can show you exactly what I'm talking about right here. So if this was wave 1 where you have 1, 2, 3, 4, 5 for 1, well then, well, hold on, I want to make sure. No, I'm sorry. It's here. It's here. 1, 2, 3, 4, 5 for 1 or 1 here. But if it's 1 here, you have the A, B, and then 1, 2, 3, 4, 5, C for 2. So let's measure. And I'm going to measure right here. And I'm going to say that this is an expanded flat B there. I'm going to take out so you can see everything, all the rest of this. Move it over to the right and change this to 786. As you see, I changed it to 786. 1851 is 0.786. Prices found resistance at 1858. Okay. Also, if you look at the particular 0.786, and if you look to your left where my Ichimoku cloud is at, this is a resistance level. So I was already expecting price to find some bit of a resistance at 1850. The next bit of a resistance would have been at 1875, which right here it found resistance. So if this is a basically 1, 2 count, well then you're going to see a 3 that will probably come back to 1660 or so, and then you're going to see a 4, and then you're going to see a wave 5 that's going to put you in the levels of the wave C 1530 area like I suggested. If not, then you look at it the reverse way, and it's a bullish, well then you have a 1, 2. So you still can look at it and you do a retracement from here. So let me get rid of some of this. Nope. Let me get rid of some of this really quick. Oh, let's put this here for a second. All right, let me start over, just where you can see it. So, if it's bullish, bam. Now let's do 0.786 the other way. .6. Get rid of all this. Move it over to the right. And I'm doing something wrong here. I just need to figure out what it is because you can barely see that. So because you can see that 0.786 was 1720 and 0.618 was 1754, and it went below 0.618, but it went above 0.786. 1720, 1731 is where it halted. Perfect. That's in Fibonacci relations of a wave 2. So now you're basically going to see a 1, 2, 3, 4, and then possible 5 for 1 that should go closer to 1890, if not 1900, for wave. That would be wave one of 3, basically. And now you're going to see the move going towards what basically this would mean that this is the bottom, and now you have a 1, 2. You're going to see a 3, basically 4, and then a 5 that has to basically go above this 120.93. When you look at that, now you have to ask yourself, right now, what do I want to do? Over the past week, price has been going long. You know, you did have a short move here, but it did find support well before the previous low. So when you start looking at RSIs and any other indicators, price currently, although I have 2 different counts, it's a little clear right now that it's possible that price should go up. But at the end of the day, the whole point of me in this video is I have no idea what price is going to do, and no one else does. No matter how bad you may want to think you do, no one has the slightest idea what price is going to do. So in my discussion today about trading, you just need to make sure you stick to the plan. I don't care what the market is going to do. I'm going to wait till it does what it does, and I'm going to take my position based on that. This is why when prices was going short, I was short with it. I took nearly 100 pips. I got out. Price went above the particular resistance level. I went long. That doesn't mean that I'm scalping and I'm doing all these different type of counter trend trades and all that. It means none of that. What it means is that I'm anticipating moves, and when they happen, I take advantage of them. I make sure that my risk is low and my reward is high. And this is how you constantly on a day-to-day basis gain 50 pips here, 60 pips there. And I'm doing it with just half a contracts, but at the end of the day, it's still growing my account. That way I can still take more and more risks with the more and more money that I'm getting from these trades. It's just like playing poker. Take money off the table, and when you play, you don't even really care. I'm not saying that I don't care. I do. So it's not like poker. It's just that when I already have money off the table, then it's like, okay, if it does not work, okay, I'll just relabel it, and I'll go again. My instructor has always told me, think like an analyst first and then a trader. Do not think like a trader and then an analyst. You always need to analyze what's going on, and then you make your decisions. No one knows what is going on in this market. You have no clue what it's going to do. And there's no form of fundamental, technical, or any systematic type of trading that's going to tell you exactly what the market is going to do. So what does that mean? That means that make sure that you know what your risk is, know where you're going to put your stops at, and if you are uncertain, trade small. But you should always be trading. If you are not sure what direction the market is going, you trade small and you test it. And then when you realize where it's going, that's when you actually trade large, and you recoup some of the small losses that you've gotten, and that's how you become a profitable trader. With that, I'll leave the talking alone, and I just want to show a couple of the other markets. But this was the 240 euro. I also want to look at the 60-minute euro. As you can see here, I'm gonna have to relabel this, but clearly you can see a leading diagonal here, but that also could be an ending diagonal, because diagonals are diagonals. So you can label this as an ending or a leading, and it can be an ending diagonal, wave 2 basically, or it can be a leading diagonal, wave 1. So my thing is, if you look at the RSI here, prices appear like it's on its way back down. But and if you look at RSI, I mean, you can see here, you can clearly see divergence. This is on the 60. I rarely trade on 60 minutes because there's a lot of fake outs. You know, you think it's going to do one thing, it does the other, and you just never know with the 60s. I like to do 240 and higher. But either way, I'm now long in the euro, and with the pound, let's see if I can got a pound. So I wanted to talk about a particular discussion I had. I don't know how to pronounce your name, but I'm hoping you're watching this video for Felicity. But if you know who I'm talking about. You sent the comments, and like I said, I've always appreciate your comments. So I want to explain what you were talking about in the previous comment that you sent me last night. The thing about the correlations is I do pay attention to them, and they often are correlated. You know, the pound is often correlated with the euro dollar and vice versa. And you know, if you're going short the euro, then you may want to go short the pound as well. The thing about it is on the Elliott perspective, they may not always be in the same waves. So if this particular top is the top, and this is wave 4, well, you can count this as wave 1. This will be wave 1 of 5, and this will be A. Then it's a possible B that can find some support at about 31.20 or so, and then you can have a wave C of 2 that can come back to 34. So that's about 200 or so pips. That is a possibility. This particular top is still under pressure until prices breaks this 4. So it has to go to 127 before you can clearly say that is it. Now it is invalidated any other alternatives, and now this particular top is wave 4. I honestly don't have time to wait for the market to go another 400 ticks before I actually take a short position. I'll rather go long and take my chances. And here's my analysis, my thought process on that. If I was to go take a long right now, even though I was going short in the euro, my thing is this: if this is wave B, I would really technically I could either go and put a stop here at 31.24, or technically I could do it at 30.29. So you're looking at about 100 tick risk to gain roughly about 200 plus ticks. So it's still a 2-to-1 trade. Is it worth it? I wouldn't say so unless prices continue to go higher and this top wasn't the top. Reverse it and look on the flip side. If this is 1, right, and this is A, this is B, this is C for 2, well, getting in at around 135 or so would have stopped at 136 or so, with the expectations that price should not go above the high and you'll be trading wave 3. Well, you already know that if it's wave 3, it needs to start making its way below 127, then below 125, and then below 121. And once this entire wave 5 is done, it has to go below this 3 at 119. So the risk reward is obviously trying to wait for this to go up. And if this is the top, you take the trade as close as it gets to the particular top, and you put your stop there. And if you played it out right, well, then you're talking less than 150 pips for of a stop loss to gain nearly 14 plus 100 pips. That's a once in a lifetime trade, and you just add on as it continues to go down. You start off small. As it starts to get in this area, you add on. As it starts to get in this area, you add on. And then as it starts to get in this area down here below this 2, you add on. Because once it passes this wave 4, well, then that top is pretty much confirmed that it's there. and then you just find places to add on depending on the waves. So with that being said, this is why I always have a primary and an alternate, and my primary may not be the best one when you look at my analysis. It may not be it, but at least I'm going to give you two sides of the same fence. Basically, I'm going to give you a double-sided trade. I'm going to give you a long. I'm going to give you a short. And when you look at it and you analyze it, you put your own indicators in there and you do your own analysis, it should give you the best possible trade, because my analysis is not always correct. Neither is anyone else's. I expect to take losses. When I take losses, they will be small. I expect to gain profits. When I take profits, it's going to be large. That's the way I trade. So I hope this helped. I definitely wanted to keep it as short as possible, but I did want to just talk about just the strategies and the psychology of trading and how I analyze markets. I hope this helps, and I will look forward to posting another video hopefully tomorrow. I don't think I am in anything else other than I am testing out the Euro Aussie, I believe. Yeah, I'm testing the Euro Aussie out right now, and it's doing okay, but I'm not sure if my one is here or my one is here. If my one is here, I have an A, I have a possible B, and I'm going to expect a C for 2 to come back to 144. If my one is here, well then I expect a move to come back down closer to roughly 142, if not 141 area. So from the looks of it, it is possible to see another high and then a drop, but we'll see. So with that being said, I look forward to posting something tomorrow, and we'll see how this Euro trade plays out. Tomorrow should be a day to where you should see some more volatility in the markets. For now, my stop is actually, I only brought my stop down so you can see where it's at, but my stop is now right here at 1798. So I'm really only up 10 pips compared to the 1850 that it's at. If I see price start to break the 1824 level, then I'll probably raise my stop just to lock in at least 30 of 60 pips, so that I at least walk away with some profits. But from the way I just looked at it, price can go it can go different ways. If correct, hopefully that this is wave 3 or wave 3 here, and this is wave 4. We should see prices move to the upside. If prices continue to trend down, it's still possible that we're not that wave C is not yet complete. However, on the flip side, this could be the top of wave 5, and we can see a larger move down. So just keep that in mind. Any questions, feel free. I'll try to answer them as fast as I can, but I keep in mind I do have a part-time job as well, so I'm not always able to respond right away. I like to respond talking versus typing, but if it's something if it was real quick, then I'll do it as soon as possible. Other than that, happy trading, guys.